Hello, I'm here talking to Charlie Dutton, who is manager of the 91 Asia Pacific Franchise Fund. Hello, Charlie. Lovely to talk to you.
Hi, Dylan.
So let's start with this. I'm interested in this. Okay, now I have covered this area for a while. What Asia funds traditionally do, in fact, what all emerging market funds do, is they usually approach investing in one of two ways. Either they are, we pick the small stocks and hope they become the next Tencent. They're real growth plays and trying to find the right companies or find the right sectors. Or they're just China is the growth engine of the world. Let's essentially asset allocate to China. They're just a beta play.
Sure.
However, you're quite explicitly not doing either of those two things. Could you just talk about
I
that?
think you bring up a great point because historically that's how you actually had to invest in Asia, that it was basically a cyclical play on the world. If you wanted beta on the world economy, you went and bought Asia because that was going to grow faster than the rest of the world. What you've seen happen over the last 10 years is this emergence of quality stocks in Asia. And they've predominantly come through from the healthcare sectors, the IT sectors, and the consumer sectors. And you've now got around 300 stocks in Asia, which we would classify as high quality names, very high returns on invested capital, structural growth. And that's the key here, structural growth. They're not dependent on the economic cycle, and they're pretty diverse with where they come from in Asia. So big diversity everywhere from China, Korea, Taiwan, Australia, India, etc. And that has enabled you to actually develop a portfolio now purely based on quality names. You're able to take the cyclical aspect out of the portfolio. So we don't own stocks like resource companies. We don't own the quasi-national banks. We don't own property companies. We don't own those companies which are dependent upon an economic outcome. We're looking for structural growth, not cyclical growth.
Okay, well, let's talk about what is it then that drives the underlying profitability of those companies. In fact, let's look at some of your top tens here and kind of see
Sure.
what you've ended up with. Uh, so I do notice it. I mean, it does include names that you would see in every portfolio, like Tencent,
Yes.
Alibaba, Samsung, TSMC. So first of all, how do they fit in with what you're saying? Are they not
Sure.
cyclical? And what else do you have that isn't those things?
So a couple of points there. First of all, currently this is a 27 stock portfolio, so incredibly focused. And what that reflects, and the portfolio turnover, by the way, is around 15% a year. So what that reflects is our duration of holding is around 5 years plus. So that again shows the detail of research that we need to go into on these individual businesses to be comfortable about holding a business like some of the ones you mentioned on a 5 year plus basis. The business model's got to be sustainable, the financial model, the capital allocation, and the valuation also has to be attractive. I find it slightly distressing is the wrong word, but slightly disconcerting at the moment that some of the best quality companies in Asia are also the large companies in Asia. So you're right. TSMC, Samsung, Alibaba, Tencent, these are great businesses which you want to hold on a long-term basis, and they are fairly well held across other funds. What I would highlight though is that our position sizing in those individual stocks are very high because of the concentration of the portfolio. But also, if you look back over the last 12 months and look at the performance attribution of the fund, none of those stocks, the mega caps you've just mentioned, were actually in the top 10. So we've also got this great tail of stocks, which is really contributing to that performance and really differentiates the fund. And I think when you look at our performance signature on the fund, you'll see that it is quite differentiated from those other funds which do also have those holdings.
I mean, is most of the kind of growth and most of what you look for, are these stocks essentially, how much of them are supported by the Asian consumer, the growth of the middle class in Asia? That story, is that
Sure.
essentially what you're looking for?
Yes and no. I mean, it's a large part of the story. You've got these incredible figures coming out in terms of how much middle class growth you've got going forward, but it's also about companies which have got particular niches. And you're looking at the healthcare industry, you're looking at the IT industry. I mean, when you look at the semiconductor industry at the moment, for instance, and you look at Samsung and TSMC, that those aren't really about the growth of middle class in Asia, but it's about the growth of computing power globally. And if you believe that computing power globally is going to grow going forward, those are businesses which are going to benefit from that. So yes, there's an Asian angle there, but it's also about the propensity to grow with the world as well.
In fact, let's talk about whilst I have you here, and since this has become this massive story, and yeah, you've obviously got TSMC, which is at the beginning at the center of this global chip shortage, so like CPUs,
Yes.
GPUs, computer cards, and and especially because everyone's at home, desperately wanting to get the new latest Apple
Yeah.
MacBook with the M1 chip and all the rest of it, and then suddenly everyone's saying, oh no, sorry, there's huge delays. Now,
Sure.
could you just because obviously you must have looked into this, just talk us through what is actually happening there and how is it
Sure.
affecting profitability of your holdings?
I'll just take a step back quickly on that. And as I mentioned there, that if I looked at TSMC or Samsung 10 years ago, they were not high quality businesses. The semiconductor industry was very cyclical. And as a result, you had these boom bust cycles, and the financial characteristics of those businesses were actually pretty poor. You roll forward to today, and Samsung absolutely dominates in terms of the memory space, and TSMC dominates in terms of the logic space. And the result of that is because that's completely consolidated, and this comes to your point, there's less of a boom bust cycle. So even though the cycle is very much on the up at the moment, you're not seeing lots of new supply being put on because Samsung and TSMC are much more disciplined about putting new supply on. What that results in is therefore that you can get these shortages because you aren't getting this excess supply being put on as demand increases. Just on your particular point there with regards to autos, what actually happened there was TSMC looked at the beginning of 2020 with COVID crisis and went, right, auto sales are going to be down. We're going to redirect some of our production capacity to other areas, whether it's servers, whether it's PCs, whether it's consoles. And that's where they directed some of their attention to. When the auto manufacturing industry came back and said, actually, we need these chips back now, they were like, well, sorry, that capacity has gone somewhere else. Wow. And that's why they couldn't immediately re-engage it. But it is fascinating. And one of the other companies, and just to give you an idea of how we look outside those mega caps in Asia, one of our other significant holdings in the company is actually a Dutch listed company called ASML. So ASML actually makes the lithography machines for TSMC and Samsung. These are called DUV and EUV machines. And they are the key components at the moment to progressing chip efficiency and productivity. And they have complete market share, particularly within the EUV area. About 80% of their revenue is from Samsung and from TSMC. So we look at that and I go, well, why not actually buy the guys who are producing the picks and shovels? And that actually, they've got an order book out to 2026. So there are many different ways of playing this long-term cycle that you're going to see in terms of increased requirement for computing power going forward.
Out of interest, is there another? I mean, one of the big things that's dominating, like most fund managers who are talking about the developed markets, is the move towards renewable energy and sustainability and ESG and all the rest of it. And China, as I understand it, actually has made a commitment to, is it by 2060 they're going to be carbon neutral? I mean, so no one was expecting that. In the ESG, they said what? Delighted, but also not sure whether to trust it. Give us your view on whether that's true, what it will mean again for your portfolio.
Well, Dylan, I'll do a horrible name drop. Obviously, I'm based in Cape Town, but on Tuesday we interviewed the Chinese ambassador, His Excellency, the Chinese ambassador to South Africa. And he was very interesting because he went through a lot of the duration of how they've taken 700 million people out of poverty over the last 40 years. But then I thought the most fascinating thing was he said, and our plans out to 2035 and our plans out to 2049. And they have these plans in place which they can actually implement. And you kind of think about that and you think about, well, how is a 4-year economic cycle built around democracy going to compete with a country which can take a 20 or 30-year plan? So yes, they can take these material step changes, they can action them very effectively, and they've got the resources to do it. So I think you are going to see all those renewables coming through, the reduction in the amount of CO2 production, and they can actually implement it. Now, from a fund perspective, a lot of those industries that we've just mentioned there don't really carry the financial characteristics that we like. There's a huge amount of capital expenditure up front. The working capital cycles can be pretty poor, but it's very positive for the country as a whole. That's
really interesting. Also, interesting that you're kind of, I guess the move towards having independent central banks is a sort of attempt to disassociate, the electoral cycle with kind of those decisions. Yes. Also, it's interesting. It would be interesting to note, is democracy bad for investments?
Dylan, a fascinating point to question on that is when you look at the development of India v. China over the last 20 years. And there's been a clear winner there in terms of one who's really managed to put in a strong amount of infrastructure, new developmental cycles, and has seen significant change in their GDP output as a nation, but as a per capita basis. And you could question whether has democracy really helped one of those countries, whereas not having a vote hindered one of those countries. And if you asked individuals in those countries how they would answer that question.
Yeah, really, really fascinating. Let's talk about what the impact is. Okay, obviously you've got longer term holdings. You're focused on this sort of quality over time. obviously for fund buyers, for the people watching this, they want to know, so what? So what does it do to
Yeah,
my portfolio? So an awful lot of funds in general basically match their sector. They might be 1-2% higher, or they might be 1-2% lower, but they're very, very closely correlated. So could you talk about
sure.
the sort of performance
Yes.
behavior of your fund?
Again, I just will reiterate structural growth, structural growth, structural growth. But the fund basically, if I'm looking, we model all our stocks in the fund to a great deal of detail. And if you look at the cumulative modeling of that within the fund, you're effectively looking at a fund which has a free cash flow growth of around 15% per annum over the next 5 years. So that effectively is what the free cash flow is going to compound at. And then you have some share buybacks and dividends on top of that. So you're looking at between kind of 15 to 20% free cash flow, or shareholder return, you could call it, in that aspect. Obviously, the starting valuation and the finishing valuation will change that, but this should be a fund which you should look at compounding at around that rate over time. And certainly since its inception, that's exactly what it has compounded at. What you will get, therefore, is that during down markets or flat markets, you'll see very strong alpha generation. But if you do get a sharp cyclical upswing and you see the resource sector doing particularly well, if you see the financials doing particularly well, if you see a sharp steepening in the yield curve, for some period, this fund will underperform during that, but compounded over time, because its ability to reinvest at very high rates of return, that growth will outperform the index as a whole.
Let's end with a bit of an outlook. Obviously, there's a whole region that you're looking at here, but just, I guess, over the next 12 months or so, are there developments, either opportunities, surprises that you are maybe thinking might happen, or potential threats looming in the horizon which will require you to change things? Just give us a view of a couple of things that you're either looking forward to or rather fearing might happen over the next year.
I mean, we quite enjoy market dislocations, and you're getting a bit of a market dislocation at the moment in China tech, where there's regulatory concerns. I think there's been a lot of inflated prices within some businesses which don't necessarily deserve to trade at the multiples that they do. And what we have is we have a number of stocks at the moment in the portfolio, not in the portfolio, on the bench. So we've got, as I say, 27 stocks in the portfolio. We've got these positions of stocks which we like, but we'd like to get in at a cheaper level. And certainly what we're seeing happening over the last few weeks, and I think this might continue for the next few weeks, we're getting an opportunity to potentially upgrade the portfolio by including these new positions in the portfolio, which have better financial characteristics in terms of quality, growth, but also the valuation is now proving attractive. So I think you're going to see further opportunity, particularly in businesses where maybe the underlying investor doesn't exactly know what they've bought or what it's worth. And so there is quite a lot of overextended investment in some of those tech names. So we're very excited on that side. And similarly, when we look around the region, we've got 4 or 5 names in Korea, Taiwan, and India in particular, which we'd really like to put into the portfolio. But the difficulty we're having is actually finding something we want to sell, which is a great position to be in.
All right, that was fantastic. Thank you so much, Charlie.
Thanks very much, Tim.
Obviously, there is the main event happening, which hopefully all of you will come and join us, where we're going to be having a big discussion about many, many of these issues, plus, of course, many other issues in the Spotlight on Asia. That is on Thursday, the 15th of April at 9:30 a.m. Hope to see you all then.